Welcome back. We're looking at the quick service restaurant segment. Remember, a couple of weeks ago, we had done this on Editors Roundtable, and now there are a bunch of brokerage notes also turning positive on the QSR space. So just let's look at what's happened. Over the last few quarters, there's been a lot of weakness, and the third quarter seems to have shown some signs of improvement. That's what we've seen in the same store sales growth. This is Westlife India's McDonald's. If you look at, KFC, Sapphire Foods as well, it's still a negative 3%, but marked recovery from what we've seen over the last few quarters as well. Jubilant Foodworks has been doing a lot better. Burger King too has seen a recovery from the previous quarter itself. Pizza Hut India, we've been looking at numbers from Sapphire Foods and Devyani. Out there too, it's turned positive after almost 7-8 quarters of negative same-store sales growth. And Domino's, which had been doing a lot better as compared to the industry, has only gotten a shade better with 12.5% like-for-like growth in the third quarter itself. The fear was that, there is a lot of competition eating away from the platforms itself. Now look at that. While revenue from quick service restaurants is increasing, the revenue growth from Zomato and Swiggy's cross-order value is reducing. So, over the last few quarters, if you look at it, it's down to 16.8% in the third quarter itself. So the question is, what exactly has changed for QSRs for everyone to suddenly turn positive, or have they turned a corner itself? The first thing is inflation has shifted urban consumption towards affordable treats. We know that, these companies have increased their value offers on both delivery and more so in dine-in. The companies have rationalized their stores from dine-in to focus on delivery as well. And even the new stores that are opening, they're opening in tier 2 and beyond towns itself, where there is already some sort of latent demand. A lot of the companies like Jubilant Foodworks, which already have their own delivery fleet, have waived off their delivery charges. And McDonald's in the Mumbai region itself has started with their own delivery fleet, rather, that is. There have been high markups on platforms like Zomato and Swiggy. Our colleague Abhishek keeps posting on X every once in a while that his restaurant menu is a lot lower than what they're charged on Zomato and Swiggy. And then there have been innovation on menu and new product launches as well. There's been McSpicy range, Domino's has that cheesy volcano, etc. And earlier there was competition coming in from local chains as well. Now reports suggest that 80 to 100 local pizza outlets have closed in Ahmedabad itself in the last 10 months. So assuming that, competition from all ends is waning, inflation is moving towards these companies, moving towards value offerings, can they make a bit of a comeback or not? So what we'll do is, this was a rehash of what we had done about a couple of weeks ago. Yesterday, there was a note that came in from Goldman Sachs. Arnab Mitra, who's the India Consumer Analyst, joins in to focus on the quick service restaurant space itself. We'll get his perspective in and his top picks. Welcome back. Since we spoke about QSRs, Goldman Sachs had said that the tide is turning for India QSR, where the players are now gaining share within the food delivery market. Remember, we had a conversation with Arnab Mitra earlier itself, sometime a couple of quarters ago, where the company said that the incremental sales of all the quick service restaurants was lower than that of Zomato and Swiggy, telling you that they were losing market share. He said the same for a lot of the retail and quick commerce players as well. So now that, quick service restaurants may be gaining market share, he's come out with this note saying that delivery channel and dine-in have seen a marked recovery. Arnab Mitra now joins us. Arnab, you've been on top of this, the trend, capturing the trend of both quick service restaurants and the retail space itself. Now that there is a revival, let's ask you the basic question. What are the factors that are causing this revival? And the second part is this just a cyclical recovery from a low base, or do you think something has structurally changed?
Sure. Thanks, Mangalam. I think if you look at the data which we captured in our report, it was quite stark that about 4 quarters back, we had 27% growth in the food aggregator GOV, while the organized QSR had grown just 9%. So it showed a huge loss of share to new restaurants, regional chains in the delivery channel. What we've seen this quarter is the organized QSR companies which are listed put together in delivery terms grew around 21% compared to the food aggregator ecosystem, which grew around 17%. So that's where the data point came in that this tide has turned. It was anyways turning over the last few quarters, but this is the first quarter where the growth picked up above the food aggregator growth. The other one is the dine-in, which has been negative and actually declining for many quarters, has turned positive this quarter. Now, to answer your question on what has really changed, so see, in the consumer industry, QSR is probably the only industry or only segment which is a bit cyclical in nature. And the reason for the cyclicality on the demand side, it's a very discretionary category. So when the economic conditions are great, the growth can be very high. And when there is a bit of a tough economic condition and the consumption slows down, growth can be very bad. On the supply side, it actually has low entry barriers. It doesn't cost a lot to open a small restaurant. So what we tend to see in this industry is cycles of overcapacity and oversupply leading to slowdown. So what we've seen recent last year, coming out of COVID, we had really strong growth in the QSR industry for obvious reasons. And all restaurants chains started adding very large number of restaurants. Also, a lot of standalone restaurants opened, a lot of regional chains were expanding because of the availability of the aggregator network, which had expanded. So in fact, one interesting data point is FY23, the listed space that we track added 33% new restaurants over FY22. And you can only imagine how much more was the addition if you were to add all the new chains and all new standalone restaurants that opened. Today, if you see it, we are going to add about 10 to 12% restaurants next year on the base of FY25, based on the guidance from various companies. So the supply side, which had gone very aggressive in terms of addition, has started moderating. And to our mind, that's one of the key factors playing out here. A lot of restaurants, anecdotally speaking, probably were making losses and therefore have shut down. And the pace of supply addition has slowed down. So I think that's one factor which gives us confidence that this is not just a low base bounce, but fundamentally the industry is getting back into some normalized supply. On the demand side, Mangalam, there's another dynamic playing out here. I think all the QSR chains had focused a bit on the premium segment coming out of COVID. So we had heard about the gourmet pizzas and the premium burger ranges coming out. Also, the price hikes were very high in 2022, partly because of input cost inflation. Pizza prices had gone up 20%, fried chicken prices were up in double digits. So I think affordability, the focus on value, that had slightly gone on the back burner in that high growth phase. What we are seeing is companies dial back into value. So we have seen no price increases for the last 24 months. And there are some companies who have actually given back value to the consumer by waiving delivery fees and offering lower price products. So I think this demand side also is responding to that stimulus that the companies have given in terms of their own strategy. Now, what makes us slightly more positive also is that the catalyst like the income tax cut, which will start coming in from the June quarter, and lower food inflation, which we have seen in the last 2 quarters, possibly will start also playing out.
Right. Arnab, good afternoon. Actually, thank you for joining in. And so do you expect this trend, this shift from premiumization to a more affordable value proposition as a sustainable trend? Do you expect that to continue? And will that result in more people preferring to eat out rather than compared to order in?
Yeah. So I think QSR fundamentally, value is the core bedrock of the QSR industry of the world. So I think it's absolutely important for QSR to give value to consumers because the growth is going to come from new consumers. It's very low penetration industry. The organized share is extremely low in this industry. So that I think is absolutely an essential component. I would not put it specifically dine-in versus delivery. What in fact we wrote in our note is within the delivery channel, the QSR is now gaining share. And of course, dine-in is having its own comeback. So for both dine-in and delivery, it's extremely important to have this value segment. And therefore, we think in both, we are seeing an improving trend. However, specifically on dine-in, an additional point is that most of the restaurants are now charging a premium price on the delivery channel compared to when you dine in the store. And that could have some role in shifting, getting the dine-in traction back because end of the day, it's a value business. And the value is more in dining in compared to delivery, as if you just take the prices that the consumer have to pay at the end of the day.
All right, that makes perfect sense. Just before we, leave you, Arnab, I wanted your thoughts on 2 things in particular. One is that when you started, you said that when the economy is good, QSRs do a lot better. When the economy is sluggish or the consumer environment is sluggish, QSRs don't do as well. Right now, the tide has turned despite the consumer sentiment not actually being very good as reported by other FMCG companies. That's point number 1. Secondly, what would make these aggregators and platforms come back? That's the second point. And the third one is that I see your picks. You prefer Sapphire, Devyani as the long-term structural opportunity in KFC. You also like Westlife, given the company's brought back focus on value. What's conspicuous by its absence is Jubilant Foodworks. Is that largely a valuation call?
Yeah. So I think on your first point, I think a lot of these restaurants we cover are actually completely dependent on the aggregators for their delivery business. So it is not really a call aggregator versus QSR, but QSR versus the non-chained QSR market, where the QSR market had shifted dramatically away from the chained QSR in terms of share, and that's probably coming back. And that's what's giving us, to your question, that's why you're seeing a growth pickup without the macro picking up, because it's a bit of a share gain within that whole ecosystem of eating out. If the macro picks up, we should see more pickup from where we are right now. And remember, a lot of these companies are still just about in the positive or in the slightly negative SSG territory, despite the trend that we spoke about. So this pickup trend would probably strengthen if the macro also is supportive. Now, to your second question on why our preference for fried chicken as a segment, that's really driven by a couple of things. We had done a lot of research, looked at fried chicken as a category across the world. It tends to be less competition long term because it is a slightly more value-added format in terms of the supply chain requirement of fresh meat. The capex per store is much higher. So world over, the market share concentration in fried chicken is higher. So we feel long-term competitive risks are lower. And secondly, the current penetration of the fried chicken market is much lower in terms of number of stores. So our preference for the fried chicken category is largely to do with the lower competition and longer runway for growth, while all chains should benefit in this upside.
Appetite. But we will have a conversation about this once again. But for now, thank you for putting this perspective for all our viewers. Running a little short on time.